This, in question 4, we make a bad debt allowance of 10% of the balance due to debt age concerns. A bad debt is obviously a debt that we do not receive, and the debt age concern refers to the knowledge that as a debt gets older, it is a lot less likely you are going to receive that money. So we, from whatever historical analysis we have done, or from ever, we look at the people who owed us money, and we've determined that some people are less likely than others, or however it is. I've given it a number here of 10%, you might have 1% to whatever it may be. So the bad debt allowance, so this relates specifically to the people to whom we have given credit, or we have allowed to pay us later. Now this, in our accounts, obviously refers to our accounts receivable. So just put it here. Now we are saying that 10% of our accounts receivable will not be received. Now there is a more significant process for this, because naturally at the beginning of the year you might determine that 10% isn't going to be received, but you do receive some of that, and therefore you need to rectify it. So instead of taking the money you owed, reducing it, increasing it, and reducing it again, as the case might be, you would open another account. But we're going to do this the simplest way possible. And if we're going to say we're not getting the money, we're just going to get 10% of the money that we are owed. And I'm going to do the same here, because obviously VAT, bad debt, VAT. Right, and that's it. So this is technically now is the money that we are going to receive. And now we still need to account for this. Now the thing when it comes to bad debts, this can actually be accounted for in a variety of different ways. It depends on the systems that you use it for. But when we talk about bad debts themselves, right. Here, this is the bad debt account. Now, of course, bad debts are bound to be a cost to the company. Are they a sales cost? Technically, yes. I suppose you could say you could put them into sales if you wanted to. Are they a cost of sales? Cost of goods sold. I mean, so therefore, technically, you could actually take them away from the cost, or add them to the cost of goods sold. I mean, they do technically fall into any variety of different category, and I mean, depending on how you're accounting for it, will depend on where it goes. I've simply put it in here as what we call an undistributed operating expense, because when we're doing our income statement later, you will see that we do it per department, and as a result of which, we are not saying that there is a specific amount for each department. We're doing this across the board. Maybe there is for each department, and you will put it into your sales. But for our case here, we're just going to put it in as a general expense, because we have combined them all together. So I'm just going to put in a bad debt, and I'm going to put in. As you scroll down in Excel, you can see that if this is K19, as I scroll down, it just goes down one as well, so it'll be K21. So that's why the numbers follow. So therefore, that's basically it. We are allowing the bad debt. Right. The only difficulty we have with that, and that's technically it's okay, but the problem with all of this is we have accounted for here our VAT. And that's all well and good. We've just said that we've written this off in a bad debt, say that we're not going to get our VAT. But if we leave it here, it means that we are saying that we aren't going to collect the money, as in up here we're saying we're not going to collect the money. And down here we're just accounting for the money we didn't collect. But the tax man at the end of the year is still going to ask you for this money, this 4,100 that you did not collect. So that's why we can't actually put the VAT here. Because if we put the VAT there, it means we still need to pay it. It's not us in the 20,000, we're just writing off. Because it's unfortunate, but that's what's happening. But the 4,000, yes, I can write that off, certainly, no one will stop you. But at the end of the year, the taxman is still going to say, you made 20,000 worth of sales, give me the tax relating to that 20,000 worth of sales. And you didn't receive it. So you're paying money for a sale that didn't actually get liquidated as such. So what we're going to do here is we are going to come across to our VAT payable account. So this is our VAT payable. And let's get rid of this, we don't need that. Right. And I'm going to put in here, that's good, isn't it? So in this case here, our bad debt VAT. And what this now means is the money that we received from ourselves, we still need to pay the VAT on. But this amount of money here that we are not going to receive, we've discounted from our VAT. And this just means then that our VAT bill will be less. If we don't do this, we will continue to pay the 207,000. The VAT man is going to be more than happy with that, but we won't be.